In this video, I'm introducing the new Advanced Technical Analysis series here in the channel. These are going to be videos analyzing tricky market situations so you can learn the things you should be looking for when the market is not clear. Perhaps most importantly, we're going to observe the alternatives you have when the trade doesn't go according to the plan. Without further ado, let's begin with a challenging example in the Euro-USD 1 hour time frame, remembering that the techniques being taught here are universal, meaning that they can be applied in any market and any time frame. From number 1 to number 4, we can see a lower high and a lower low in what appears to be the major flow in this market. At this stage of the analysis, it's useful trying to detect the minor flow as well, because a big part of the decision of entering a trade or not will be the interplay between the major and minor flows. So in this first chart, we can see the major flow highlighted in black lines, and in the second chart, we can see the minor flow highlighted in red lines. It's also interesting to erase the raw price section and see the abstraction of the major and minor flows like you can see in this third chart. This helps you realize that there is in fact a structure behind price motion despite the apparent chaos. At the current moment, we see that the major flow is in a lower low after creating a lower high. So for all intents and purposes, the major flow is in a downtrend. In the price vector from 3 to 4, we can also observe a downtrend simply by observing lower highs and lower lows as well. At this moment, the question that emerges is whether or not number 4 is a major turning point in this market. We can define a major turning point as a point where both major and minor flows will agree with each other, meaning that both will reach a point of exhaustion simultaneously, and that will create a more significant reversal in price. We have several different ways of investigating if that's the case or not. We can start with one of the simplest ways, which is by using a channel in order to assess if the market has reached an extreme according to the recent geometry produced by price vectors. The way we would do this in a situation like this is to create a line connecting points 1 and 3, which will generate a line with a specific angle, and then duplicate this angle to the low in between the two highs that generated the angle in the first place. Notice that I'm using the simplest kind of channeling here, meaning that I'm using only real grounding positions. One detail that emerges here is the shy frequency undershoot in the lower channel line. The original lower channel line is already good enough to project the low number 4, but the undershoot line explains the lower shadow of the current fractal candle. We can reach a similar result by using a slightly more advanced type of channel based on abstract grounding positions. By abstract grounding positions, I mean the outer frequency of the major extremes. This is best understood visually, of course. In this other chart, I marked the upper channel line using the abstract grounding positions in number 1 and number 3. These are slightly different than grounding the lines in the absolute extreme, but the subtle change in the grounding position can be critical. In this other chart, I extrapolated the same angle to the abstract position of the low number 2, which is the low in between the two highs that generated the angle in the first place. Notice how the abstract grounding of the channel lines eliminates the necessity of using an undershoot line. That's a common effect in the geometry of price vectors. In conclusion, the channel is telling us that number 4 is indeed a market extreme, but of course that's not enough. We still have to integrate other techniques in order to increase the chances of being accurate. Keep the channel in mind as we move forward to different modes of analysis. Let's look at this piece of price action from the perspective of the Andrews pitchfork, starting with the most obvious alternative, which is to ground the pitchfork in numbers 1, 2, and 3. The first thing that should grab your attention here is the fact that this standard pitchfork is generating an angle larger than 45 degrees in relation to the x-axis of the price chart, and that this is an indication that we should transform this pitchfork into a modified shift. But before we do that, we can extract some good information using this apparently detuned pitchfork. Notice that after high number 3, which is the c-axis of this pitchfork, price action goes outside the boundaries of the fork, and that can be a useful piece of information. In other words, when price respects the lines of a pitchfork, we have obviously useful information. But when it disrespects the line, the information can be useful too, even though that will happen in a non-obvious manner. If we tune the standard pitchfork to the price action that breaks it after high number 3, we'll see that this piece of price action acts as an overshoot to predict one of the lows in the minor flow right after. The upper line of the fork also catches the upper shadow of a fractal bar that marked a minor reversal. Interestingly enough, low number 4 is in a position that if price reverses to the upside, the power of a reversal will be greater due to the Hagopian's rule, which is simply when price fails to hit a pitchfork line that has been tested and confirmed. In other words, the fact that low number 4 fails to hit the center line of the fork is greater indication for a reversal. Similarly to what we did with the simple channel previously, we can reach a similar situation using the same fork but in a different way. Instead of tuning the entire fork to the price drift after number 3, we only reposition the C-axis to the boundary of the price drift. That will create a width pitchfork with very similar properties to the tuned fork we just saw. In summary, the width pitchfork is suggesting the possibility of a Hagopian's rule. There are other things we can do with the pitchfork in here. Remember that I said this pitchfork had more than 45 degrees in relation to the x-axis of the chart, and that this suggests the transformation of this fork into a modified shift. That's the case because forks with angles that are too steep don't tend to work as effectively. By transforming the standard fork into a modified shift, we immediately recognize that this is in fact the same line we reached with the simple channel that was previously drawn. In fact, the angle of a modified shift is always the angle created by the connection between the A and C axis, as you can see by the red line in this chart. Other than channel lines and pitchforks, we can apply different perspectives to this piece of price. Let's look at a couple of different ways in which we can analyze this in terms of volume. Start with the simple volume histogram. In the most recent price action, we can spot a clear volume divergence in the minor flow. Notice how the lower low produces a lower volume. In order for this last lower low to be confirmed in terms of volume, the histogram should produce higher values instead of lower values. That tells us that this price movement is not as strong as it seems to be when we look at raw price action. This is one type of information that we cannot derive purely from price. We need the perspective given by the volume histogram. We can also see the same volume divergence pattern in the major flow simultaneously. By comparing lows 2 and 4, we'll notice that the lower low in price creates a lower high in the histogram, which is the same pattern we just observed in the minor flow. This is a case of double volume divergence because we have one happening in the major flow and one happening in the minor flow simultaneously. A double volume divergence is of course stronger than a single divergence simply because of the overlaying effect. Another interesting perspective we can add here in terms of volume is by using the anchored volume weighted average price, or anchored VWAP for shorts. This is an interesting indicator that lets you choose the starting position of the calculation, unlike standard technical indicators, which use a fixed size rolling calculation window. The VWAP works as some sort of volume adjusted nonlinear Bollinger Bands. In this case, the VWAP line is plotted in blue, and then I plotted additional 2 sigma and 3 sigma lines, meaning 2 and 3 standard deviations away from the VWAP line in order to create a dynamic band of possible price reversal. The grounding of the anchored VWAP is on high number 1, but it could be on other extremes as well. Notice that number 4 is on the space between the 2 and 3 sigma lines, which is another indication that this is indeed a market extreme, or at least it's close to one. The fact that we can anchor the VWAP indicator on specific highs and lows eliminates some of the bad attributes of technical indicators that rely on rolling calculation windows. Another perspective we can add here is of the Elliott wave counting technique, but only in the simplest sense possible. I have said in the past that I don't think the overly specific rules of Elliott wave are good, but the general and simple guidelines can indeed provide additional insight about the market. When I say general and simple guidelines, I mean that if you can find price vectors that can be broken down into patterns of 3 or patterns of 5, there is a slightly higher chance of a reversal after them. That's certainly the case with the vector formed between number 3 and number 4. Notice how we can clearly identify 5 waves going down in this price vector. Which wave this is and what degree it's in is really not important here unless if you are an Elliottian. I'm only concerned with the idea that we can find a wave count that fits the general rules and guidelines provided by the theory. Notice that wave 4 doesn't retrace into the territory of wave 1, and wave 3 is not the shortest wave. Along with the simple wave count, we can use Fibonacci ratios as Elliottians do. By using a Fibonacci extension on waves 1 and 2, we can see how wave 5 apparently ends near the 261.8% level. Yet another perspective we can add in this analysis is the study of momentum through the relative strength index. Here we can spot the usual bullish reversal divergence happening plus the current fractal candle, which makes this a second-degree reversal divergence. Additionally, the angle of the minor lows in the RSI points to the current low, which is a weak indication, but it's nonetheless additional indication. As you can see, there are a lot of things converging at this point of the chart. The simple channels, both the real grounding position and the abstract grounding position, the tuned standard pitchfork, the width fork, and the modified shift, the double volume divergence, the fact that price is in the space between the 2 and 3 sigma lines in the anchored VWAP indicator, the simple Elliott wave count, the Fibonacci extension, and finally, the momentum divergence with the added twist of the slope support momentum line. Without a shadow of doubt, this is a situation where the green light for a long trade will appear, but there is no real place for a logical stop loss unless you are brave enough to use the low of the fractal candle as a stop. That's a tight stop, which is not necessarily a good thing. The problem with tight stops is that they have low absolute risk, but they have high positional risk as a result of risk conservation, something you will learn in the new upcoming advanced course. If you wanted to trade this long trade idea, which would be tempting given the number of techniques being integrated, using the low of the fractal candle is the only logical choice here. Perhaps a more conservative approach would be to wait for a dynamic frequency breakout while still using the low of the fractal candle as a stop loss placement. In this case, there would be a trade-off between absolute risk and accuracy. Before we advance price action, you have to pay attention to something important here. It's clear that we have major and minor supply zones in here, and you will face the problem of deciding which one you will trust. If price starts to go up from here, you'll need to make a decision when it reaches the minor supply zone and when it reaches the major supply zone. The immediate answer to that is that you have to wait and see how price reacts to the zones in real time. You should never trust one technique blindly. You must always integrate them. Beyond that, considering the number of techniques being integrated at this moment, it doesn't seem smart to place a short trade anywhere at this point. Let's move price forward a little bit. In this next chart, we can see that price reversed and completely ignored the minor supply zone. In fact, it passed through it with a high volatility candle. We are now at the major supply zone coming out of number 3. A couple of details here about the supply zone is that the upper and lower limits are drawn using the inward and outward frequencies corresponding to the absolute high. The zone is not roughly drawn, it is precisely drawn. Notice how the inward frequency that gives rise to the lower limit of this major supply zone catches the upper shadows of future candles in an interesting way after the major high number 3. Right at this moment, we have a candle piercing the lower limit of the supply zone and closing below it, which is an indication that there is some selling pressure in that zone. Remember that even though we are looking at evidence to support a short trade here, we have powerful buyers coming from below. So if you wanted to take a short trade here, you would need a lot more evidence beyond the simple sign of selling pressure after price entering a supply zone. Analyzing this under the light of pitchforks, we have a very interesting situation. Take a look at this chart. Here I drew 2 pitchforks. The black fork is a standard fork with the additional parallel line that uses one minor high as grounding. The blue fork is a modified shift that uses the same 2 axes of the black fork, meaning the market extremes 1, 2, and 3. Using this combination of pitchforks unveils the geometry behind the price vectors. Take a look at how the current candle pierces the intersection of 3 different lines. The upsloping parallel line of the black fork, the downsloping upper line of the blue fork, and the lower limit of the supply zone. Let's add the perspective given by the volume analysis to see what kind of evidence pops up. In this chart, I kept the pitchforks to remind you of the triple intersection, and then I added the volume histogram and the volume profile. The volume histogram is a way of analyzing volume at time, and the volume profile is a way of analyzing volume at price. The combination of these 2 tools gives rise to something called two-dimensional volume analysis. 2D volume analysis is not restricted to these 2 tools though. There are other possibilities. This is also something I'm going to cover in the new advanced course. According to the volume histogram, volume has been declining as the minor flow is producing higher highs, which simply means volume divergence. Price is rising, but there isn't that much volume to sustain it. If we take a look at the volume profile, which is grounded from the high number 1 to low number 4, we see that price is now encountering 3 areas of resistance. Notice how each level is slightly weaker than the previous one. Price is now roughly at the second volume resistance level, which adds to the possibility of a reversal given all the other pieces of evidence we found so far. The two-dimensional volume analysis is telling us that buyers are weakening at this point. Erasing the volume tools from the chart for simplicity's sake and moving on to the momentum analysis, we can see there is a simple bearish reversal divergence happening, and beyond that, the cooler detail is that the current candle piercing the triple intersection is a fractal candle, which makes this a second-degree fractal divergence. In other words, the momentum analysis is also telling us that buyers are weak, and there is a possibility of a reversal. Following the steps of the last part of the analysis, where we use the simple guidelines of Elliott wave theory to add another layer of confirmation, we can see the same pattern happening in the price vector that begins at 4. The tricky part here is that what appears to be wave 2 is embedded in the candle shadows, but minimal careful inspection is enough to see it. There's a significant distance between the upper and lower shadows in these two candles, and that represents the possibility of a wave 2. Looking at this in a lower time frame would certainly make this clear, but we don't have to. In fact, looking at other time frames would probably make things more confusing. Like the previous example, we can plot a Fibonacci expansion tool on waves 1 and 2, and once again, we'll see that the current area of interest falls in the 261.8% level. At this point, it becomes clear that this is a market edge. There are too many things happening at the same time and place for this to be just a coincidence. Similarly to what happened in number 4 with the possibility of a long trade, we now have more than enough techniques being integrated in order to open a short with the added benefit that we are close to a major solid market structure in number 3. The conservative stop would be just above high number 3, and the aggressive stop loss would be slightly above the upper shadow of the current fractal candle. At this stage, the entry is made at the open of the very next candle. Before advancing price, it's necessary to get ahead of what might happen if price indeed goes down. Remember that buyers are weak where the market is right now, but the market has a short-term memory, and if price goes down, it will encounter the level out of which strong buyers came out. We can sketch that by drawing a demand zone in low number 4, like you can see in this chart. Let's advance price to see one type of challenging situation you will find yourself in a lot. In this chart, we can indeed see that we were talking about a real market edge. When you find so many techniques intersecting at the same time and place, there is a high probability of reversal, although it's not that easy to find these moments where everything aligns perfectly. Right now, we have a challenge after price dropped from number 5. Notice that if you have been conservative in your stop loss for this short trade, price hasn't moved enough to produce a 1-to-3 risk-reward ratio. At the same time, price is at a very significant point right now, which is the demand zone of buyers that have already proven themselves very recently. Price is also at the lower line of the black upsloping pitchfork. If you use a more aggressive stop loss above the upper shadow of the fractal candle in number 5, however, you would be out with a profit already. The challenge here is deciding whether or not you should keep this trade open and what you should do about the new possible long trade at the moment. If you leave the short trade open, neglect the possible long entry, and price starts to rise, you will lose the profits you already made in this short trade, and you will miss the long trade. If you keep the short, neglect the long, and price continues to drop, you will come out with a successful 1-to-3 risk-reward ratio trade. If you keep the short, take the long, and price continues to drop, you will still be profitable despite the stop loss in the long trade. You will gain 3 stops and lose 1. If you keep the short, take the long, and price rises enough, you will come out with a profitable long and a failed short. The realization here is that since you already have a profitable short, you must move the stop at least to break even and take the long as well. Ideally, you should move the stop to profitable territory to the size of 1 stop to lock in some profit. So if the long begins to work in your favor, you still have some profit locked in the short. By opening a long at the next candle with a stop below number 4, we see that a 1 to 3 target would occur before the break-even stop of the short. In other words, there is the possibility of coming out of both trades with a profit. There is also the possibility of placing the short stop loss exactly at the price level of the long take profit target. In that way, you would get out of both trades with a profit at the same time. In other words, there are many possibilities here, and there isn't a way to mathematically reach a conclusion because we don't know the odds of each trade working. We can only speculate about the future after all. One thing is for sure, once the trade has moved enough into profitable territory, you must collapse the risks to break even. You can also act in a stop and reverse way and close the short right now with something like 2.5 risk-reward ratio. But no matter which decision you take, there is always a trade-off. The two rules that emerge out of this is that you must trail the stops, and you must increase the targets logically in a way that allows for the possibility of catching a larger trend movement. This is the type of behavior that would allow for the possibility of existence of positive outliers in the equity curve. Dynamic money management, which is the type of management done after the trade is open, is always a battle between the decision of closing the trade when it's stretched out toward the target and to retraced against the stop. It's perhaps more mentally demanding than integrating techniques in real time. Beyond that, you will always have to deal with the behavioral pitfalls as well. The most obvious one is that once you have a profitable trade, you are immediately tempted to close it because of the hyperbolic discounting effect. And when you have a losing trade, you don't want to close it in the hope that it will turn around. Both situations are traps. In this next chart, you can see that price indeed reversed at the demand zone in 4, and it kept hitting the parallel black line as an extreme. In hindsight, we can say that the better approach is to act in a stop and reverse manner while attempting to maximize the integration of techniques instead of trying to use an overly complex dynamic management approach. There's a lot more to cover on a situation like this, but the goal of this advanced technical analysis series is to give you a taste of what you're going to find in the new upcoming advanced course. The current courses are still valid, of course, if you want to increase your skills as a trader. If you liked this video, please don't forget to click the like button, subscribe to the channel, activate the notifications button, share the video with your trading community, and leave your feedback in the comment section. Thank you very much for watching, and I hope to see you in the next videos. Take care.